light the lamp, followed by Saraswati.
या कुन्देन्दुतुषारहारधवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्कर प्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा।
Welcome members. Today we have with us our own study group, study circle member and learned speaker, CA Avinash Ravani sir. He is going to take us through revised ICAI guidance note on tax audit. So without wasting much of your time, I would request everyone to please raise for Institute's motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन्
Thank you. I would request C. Ashwin Tomar to please introduce our speaker for the first session.
Good evening, friends. Thank you, Pratik Bhai, for giving me opportunity to introduce CA Avinash Rawani sir. CA Avinash Rawani sir is a founder member of Rawani and Company. His area of practice is direct tax advisory, compliance, statutory audits. His professional engagement is he is a member of various study circle of WIRC. He is a faculty and speaker at ICAI, BCAS, Chamber of Tax Consultant, Income Tax Department, and CAG. His leadership, under his leadership, he delivered more than 800 lectures on Companies Act and Income Tax Act. His key contribution and role is in a committee role of a special invitee direct tax committee of ICAI. He is a member of a corporate law and governance committee. His special things introduce ICAI publication on technical guide on ITAR forms, guidance note on revised tax audit, practitioner's guide on audit of small entities. Now I request Pratik Maru to give him a moment of BCSE. I request Viral Shah to give him a BCA's Benevolent Fund receipt. Now I request CSR to please proceed for the seminar. Thank you.
Good evening, everybody. Conveners, Borivali Study Circle, dear friends. Guidance Note 2026. Whether challenge, precaution, what should be done? The topic for discussion today. Nitin Bhai is here, one of the contributor to this guidance note. Actually, he was the right speaker for this. First of all, we should also congratulate him because his publication on deemed dividend has also come, which has been published by Chamber of Tax Consultants. He has taken lot of efforts are there in that. So today's topic is a short topic, not much more lengthy. Would like to cover only what the changes are there and what the precautions are to be taken, and if time permits, because now this is the last guidance note under Income Tax Act 1961. That is what the guidance note starts with, and this is only some of the extracts which has been taken out from the guidance note. This is only some compilation from that. Should not be taken as an opinion, should not be taken as a legal interpretation. This is first disclaimer. You can use this material with institute's permission, not my permission, but you can read the guidance note. I think how many people will read, I don't know. How many people have read last edition of the guidance note? How many people have read? Nobody's hands are raised. So I think nobody has read it. So there is no need of this meeting, right? Come on, at least let us have some discussion on it till the next speaker arrives. See, basically this is the concluding edition. This concluding editions was a surprise to all of us when it was released suddenly on the one morning. It came in August 2026, and when we were discussing it, whether to keep the meeting on it or no, at least let us have some discussion, at least some views should be there or some discussion should be there. It has 608 pages, more than Income Tax Act and more than income tax sections. There are 11 distinct areas of addition. One good thing is that in this addition that we have tax audit review board, wherein whatever tax audits are being done by the members which are selected for review, just like peer review audit board, and wherein all the mistakes which have been found out in the tax audit have been analyzed, has been compiled. And one good thing which is done in this is wherever the errors have been found out from these tax audit reports, which has been identified. And what has been done in this is, in this each of these clauses where the errors have been found out, has been pointed out that what mistakes you should not make it while reporting in this clause. So this is one of the good thing. And 2 entirely new appendices are there, which is the additional reporting for the assessment year 26-27, not tax year, because now what we are doing is discussing is of assessment year 26-27. It also says that since we are moving, this year is a transition year, because we'll have to do the tax audit in the next year, that is for the tax year 26-27, and we are doing the tax audit for the assessment year 26-27. How this both audits has to be managed and what are the precautions to be taken, or how we have to move in the next financial year for the next. So there is one guidance also which has been given, and one of the biggest challenging case was there. That was a Supreme Court's ruling in case of Saji Paulus versus ICAI. Dated was 17 May 2024. That case law is also given in this guidance note, wherein a member had challenged that why institute is restricting me to do the tax audit, because as an tax auditor I can do whatever I want to do. Number of audits, restrictions which institute has put that a member cannot do more than 60 tax audit. A suit was filed against the institute that institute should not restrict my rights. So that on the public interest, that also discussion is there in the guidance note. This is the gist of the guidance note. Then this matter went to the Supreme Court. The case was there against institute. This case was fought out, and all things matter went and all. Finally it was concluded that institute has the rights to declare, because everywhere nobody can, means it is a enacted body under the government of India Act. It has the rights to So now it is finalized that per member only 60 audits are there, can be done. When we come to the last, we will be discussing it. Then that is, it also says that now member will also have to familiarize with the new Income Tax Act 2025 ये बंद कर दो ना प्लीज, आँख में आता है. Then about working papers, audit trails, which we are all aware about when you are doing the company's audit. Some importance or some discussions on there is also there. And we all know about the data protections, this Data Protection Act. And there are two more reportings about virtual digital assets and carbon credits, which is required to be reported now in the tax audits, and something about the ethical standards, which is also covered in this edition. So this is basically related to the guidance note. Coming to the changes, these are the 6 areas, which is 8 areas which is there where actual focus is there. There is first is virtual digital asset, second is about bad debts recovery, then revision of tax audit, then tax audits of branches, UDIN related changes. You might have seen that now when you generate the UDIN, you have to give several additional informations while generation of UDIN. Then about DPDP Act, which has become mandatory now. Some time limit has been granted. So what precaution as a tax auditor, what you have to take it, that is also given. Then about Tax Audit Quality Control Board observations. And suppose if you have any issues, guidelines have been given over there. And last but not the least, the formats of the management representation letter. This material will be circulated to you. It will be available. And all the formats will also be given to you. Don't worry. Everything is there. The format of the engagement letter, format of the management representation letter, everything is ready made. Formats have been made available. Is given you the draft format. But just like audit report, just don't copy paste it. Make the necessary changes, because when the income tax notices come, you know how the notices come. 142.1 notices come. In the notices, the person, all the notices are stereotype notices are there. So don't send this stereotype management representation letters typed and send it. Make changes what is applicable, what are not applicable. Kindly modify it, and whatever things you find it suitable, you can modify it to the what you require and what changes is required to be done. The drafts have been given, so that will enable you to take the suitable draft. So these are the details. In case whatever the 2 items which have been added, now it says that first is about virtual digital assets. It says that a person who is a dealer in virtual digital assets, though virtual digital assets, it is banned in India, it is not allowed. But then suppose if a person who is dealing in virtual digital assets, that was not there in the earlier edition. But now since this is a new concept which has come, a person who is dealing in virtual digital asset, so that definition of turnover was not there. So that definition of turnover has been added. It says that the aggregate amount of gross receipts arising from the sale of virtual digital assets by a dealer engaged in the business of such dealing in assets will be treated as a turnover. So that definition has been modified. Then one addition is about the carbon credits. That is aggregate amount of gross receipts arising from the sale of carbon credits by a dealer engaged in the business by dealing in the carbon credits. So this is the amendment in the definition of the turnover or the gross receipts. So that will be, if a person is dealing in this, so this will also be treated as a part of the gross turnover. So when this outcome comes, you have to include it in the gross turnover. So this will impact the persons who are there in the this said business. So there is no virtual digital asset dedicated clause, but the amendments are there. There is notification number 23 of 2025, which is applicable from 21st April 25, has tightened the areas. You might all be aware that how it has to be reported in the ITR. Similar way, when the transactions comes to it, you have to see the similar treatment also has to be given in the while reporting in the Form 3CD. Then there is a clause number 31, which has been revamped, wherein now drop down boxes have been given. One bigger mistake which has been made, that in case where the loans and advances or the loans and deposits which has been taken, you are required to report the details in a transaction wise statement. You don't have to summarize the statement, but you have to give the details transaction wise. Suppose if the transactions are that a person has taken 10 loans in a year, you don't have to summarize, sum up the loans, but you have to give details each loan wise. It is taken that detail says that each loan. You cannot just total up the loan and give it. So that is one of the biggest mistake which is there, and you have to select the codes correctly and report the codes correctly. Another thing is that about clause number 34, that is TDS under section 194S, which is applicable on virtual digital assets, that is 1% TDS. That code is added in Form 3CD. Reconciliation of books with virtual DDL as 194R, that reconciliation also has to be taken care of. This TDS forms and also this Yogesh Bhai is coming, he'll take it all these things in detail. Then about ethical issues, the biggest fight. It says that we have that when a chartered accountant and a person who is accepting the audit, so if he is indebted to a SSC, he cannot accept the audit. That is that the provision is there, right? You are aware of it? No? This old provision is there. So that limit was earlier 1 lakh rupees. So that limit has now been increased to 5 lakhs rupees, applicable from 1st April 2026. So suppose that it says that the limit has been increased to 5 lakhs rupees. So that changes has been made. Then you cannot accept the audit without taking the NOC. That also provision remains the same, but in many cases it is seen that the people are accepting the audit without NOC. So that change has been now made in the UDIN. So now when you make the, try to generate the UDIN, at the time of generation of UDIN, it asks whether you were the auditor of the, you have done the audit, previous audit. If you have done the previous audit, put the UDIN number of the previous audit, tax audit you have done. It asks you to put the UDIN number if you are the previous auditor. So that changes has been made in the UDIN itself. So now if you are not the auditor, so that changes has been made in the UDIN itself. Then para 9.19, that is about statutory audit fees cap, that is for PSU, government listed companies and public companies having a turnover of up to 250 crores or other work, the same entity must not exceed the statutory fee in total. So these ethical issues you have to take care when you are accepting the audit. So this precaution has to be taken. This is what is also stated in the guidance note. Then about outstanding balances with the audit clients against the new 5 lakh limit has been for accepting for financial year 2026-27 assignments. Then that is in the meeting held on 31st March 2026. That is, I think, on the WhatsApp University, these messages have been going out, which format we have to prepare the balance sheets for non-corporates and LLPs. Every day the messages have been coming. People are knowing that now what has to be prepared and what. I think this needs discussion or no? Yes or no? Yes. Yogesh Bhai will take it into discussion. So phase 1 now it says that if your turnover is more than 5 crores, then only you have to prepare in the vertical format. Now vertical format is always suggested to prepare, recommended to prepare. Otherwise it has been seen that everybody is even signing the tax audit reports. People are taking the printouts from the tally and signing the balance sheets and giving it. That is what the tax audit review board has seen that. Then phase 1 it is says that for the financial year 25-26 periods beginning from 1st April 2025, 1 year relaxation has been given. So over turnover above 5 crores you are required to prepare in the format which has been suggested, and phase 2 will be for all this period beginning for the. So check whether the financial statements follow the ICAI prescribed format. The format has been given. If you want this format readily available, then this format is also readily prepared and is available on the ASB tab of our institute's website. You can just download it and you can use this format. Entities covered by the non-corporate are, that is sole proprietorship, HUF, partnership firms, registered underagers, that is AOPs, BOIs, so registered welfare associations, societies and trust, unregistered or registered, etc., statutory corporations, these are applicable. Then suppose if any prescribed laws are there which says that under their law, if the balance sheet formats are given, then you have to use their formats. If there is no specific formats are given, then you have to use the format which is given by the guidance note. And what it says that the format of the financial system, what it includes, that is balance sheet, statement and profit and loss account, cash flow statement, if applicable. If applicable means certain type of entities have been given exemptions, that is MSME, etc., and notes to the accounts. Then another that is in certain cases. Now what happens, suppose your turnover is less than 5 crores, etc., this will come, because this will come in the next stage. Now if suppose turnover is exceeding 5 crore rupees, right, as per tax audit that limit is there, no? 5% turn cash limit, you are exceeding 5%, not exceeding 5%, so you are not required to file the tax audit report, so you are not signing the balance sheet. So whether you are required to prepare the balance sheet in this format, but you are not signing it, then you are required to prepare or no? But who is preparing the financial statement? Chartered accountant is preparing or management is preparing the financial statement? Now you tell me that. Who is preparing the financial statement? Chartered accountant or management? Huh? So if a chartered accountant is preparing the financial statement, then he has to prepare. If management is preparing the financial statement, then they don't want how to prepare. Now you decide. If chartered accountant is charging for accounting fees, then he has to prepare. Nitin bhai, barobar? Then he has to prepare. And suppose he is certifying it for the purpose of banking purpose, or any other, he is doing the attestation, then he has to ensure that he is, if prescribed, follows this. Now what the things happens here, no? Audit is not required, it is just only requires stamps and signature. What to do? Guidance note says that if he is required to prepare, if you are doing the attestation work, this guidance note also says that you are required to do the site. If you do the attestation work and you are when you are doing the attestation work, you are not preparing the financial statements are not in accordance with this, then you have to report that these statements are not in accordance with these financial statements, and if you don't report it, you will be guilty of professional misconduct. So please be aware of this while certifying also. This is what it says, that subpara E of Code of Ethics Volume 2 2020 edition with respect to clause number 9 of part 1 of schedule 2. Please keep this in mind. Okay, done. Then comes one biggest accounting standards. Now once you attest it, once you prepare this, once you sign it, then you are required to follow accounting standards also. Now which accounting standards will apply? Whether Ind AS will apply or accounting will apply, that also you need to see. That is also mandatory. Companies Act section 133 says, welcome Yogesh bhai. So this is in detail. So you have to see that which accounting standards which will apply. So when we are dealing with non-corporate entities, you have to see that this is as per the ICAI pronouncement. So one big debate is always there, that certain SSEs are there, accounting standards applicable, not applicable, this applicable, not applicable. When you prepare it, you have to see the nature of what is there. Turnover criteria for MSMEs for non-corporate, that definition has been modified. So here when you deal with non-corporate MSMEs etc., so you have to see that there are only two large entities and MSME. So who will fall within MSME, who will fall within large entity? There are only two classifications. So this has supersedes all the earlier announcements. So this is the only criteria. So whose dates and securities are not listed, which is not a banking or financial institution, turnover not exceeding. Yogesh bhai will take care of all these things. I'll just skipping this. Then coming to about cash flow, which is not applicable, this you can just go through it. One biggest debate is there about cash system of accounting, whether accounting standard is applicable, not applicable, etc., etc. According to me, it is applicable, but you have to give the suitable notes accordingly. Then, while preparing the financial statements now onwards, data protection is applicable. Now it has become mandatory. So when you are doing the tax audits, guidance note says that you have to take into consideration that as an auditor, as a tax auditor, you have to keep into mind the data protection and AI. Para number 13.13 to 13.17 of the guidance note deals with this, that chartered accountants are covered now under the Data Protection Act. Because as a tax auditor, you are collecting all the data and you are keeping with your in record. So it is the requirement that tax auditor routinely handles all the sensitive and personal data of the client. PAN, Aadhaar, salary records, bank details are now all governed with the DPDP Act. Any of this data, suppose if it is mishandled and something happens, the clients can sue you under the DPDP Act. How many people have done the DPDP course of the institute? Penalty is not much higher, starts from 50 crores to 850 crores. Final last penalty, total sum up comes to 850 crores. Then you have to have a contract and a documentation which is mandatory. You have to have an updated engagement letters with data processing clauses, confidentiality agreements with staff, also with vendors, with security measures to demonstrate the due diligence. Also to ensure that these provisions have been already implemented, but full implementation will be from 13th May 2027. The time limit has been given. So from tax year 2026-27, it will be fully implemented. The time limit has been given so that you be fully compliant by this due date, by this date. So members have to prepare for the future engagements. And now AI is there. People are using AI. Upload everything on the website. You get everything readily available, and then the data is available on the public domain, right? And when this data goes to the client or on the public domain, DPDP Act will come into picture. See that it is the ultimately responsibility is of the auditor. Obligations under the Act, regulations, code of ethics, and auditing standards will apply. It is a small booklet which is there of hardly 27-28 pages, but covers full act. So what Data Protection Act says that you have to see that you have to take consent and for anything which you take from the client, whether you want to share the information. And the Act also says that you cannot share anything without the consent of anybody, if it is for the business purpose. There should be a data minimization. We have the habit to take everything from everything. Aane do. Let us see future mein kaam aayega. The Act says that keep whatever is minimum requirement which is there. Once it is done, you have to, and whatever you keep it, it has to be a secure handling of data. If it is not securely handled, you may be punished for handling more data, having more data. Once your work is over, you have to hand over everything to them. Retention has a cost which client never pays. And suppose if the retention goes away from you in an unsecured way, you will have to pay the cost for it. And then has to be erasure of the data, not deletion. Deletion is separate, it has to be eraser. Because we have everything in all separate files. This one thing was a person who was traveling with 4 tickets in a train. 1 ticket here, 1 ticket here, 1 ticket here. सर चारों घूम गया तो क्या, तो बोले पीछे की जेब में पास पड़ा है. Same condition is with our chartered accountant. ये data तो उधर भी पड़ा है. So when these things happens ना, this will be a this is a biggest problem for us. And when you are using the third party software, you have to ensure that whether the third party is also DPDP compliant. Whether it is a Winman, either it is any other software, whatever the software you are using, because you have to have a detail that whether that party is also compliant. So this is one of the biggest area of concern. So be very careful. Then it deals with the transition note, that is how we have to transit from 1961 to 2025. That is repealing of the Act 61 to 25. What transition has to be done. The new guidance note is will be coming shortly. Institute is under considering it. Let us see. Section 63 deals with, in the Income Tax Act, 536 deals with repealing and savings of 1960 Act, and next step is to issue coming up with the new guidance note. So these are the sections, that is clause number 40, there's changes which are there. Yogesh Bhai will cover this. Then TARQB observations, that is what are the observations. These are the mistakes which has been found out in each of these clauses. I have given you the clause numbers. Go to these respective clauses in the guidance note, and what are the observations which has been found out by the Tax Audit Review Board. What are the mistakes which has been found out by the and where the errors have been happening. What has to be reported correctly so that you don't land up in the problems. The biggest problem here is four biggest problems which has been identified is consolidated reporting where the item wise or payee wise details has to be given. That is the biggest area. Then everywhere is a reliance on the basis of the management representation. That is not required, because you have, when the auditor is required to give the details, he has to verify it. Management representation is not sufficient. That is what is the biggest observation which is there. Non-reconciliation with the audited financial statements. When it is coming with the Companies Act statements and when it is coming with the tax audit, both the figures are totally different. Means there are differences which has been found out. This is one area. Then misclassification, that is contingent liabilities and provisions. Both are separate things. People are considering contingent liabilities as a provisions and are reporting it. Then about net profit after tax, net profit before tax, etc., etc. While reporting also in the ratios, figures are been taken incorrectly. Just go through these specific clauses. Then about address differs from MCA records, depreciation, addition, deletions not reconciled with the MCA records are different, with clause number 18 is different, 40A to be report things are different, ICDS what is required to be reported, that is not reconciled. So these are the MSME reporting not correctly reported. These are the key findings in the TARQB. Then about ICDS is asked for the adjustments. Then about one good thing has been done, that in 40A to B, a person's which has been the nature of payment which has been made, people are reporting consolidated. Suppose a person is a person who has been made payment, a person is a director in a company, there is made for payment for four different type of payments are made. For remuneration, for expenses, people are just reporting consolidated payment, expenses type of payment. This type is not to be reported, it has to be reported in a single item way. So these all the mistakes are there. Then about quantitative details reporting, that are also not reported correctly. Ratios are left blank where actually ratios are applicable. So these are the findings. Just go through that. Then hundis, loans, this actually when TARQB review board asked for the working papers, that how these workings have been prepared, these working papers have not been able to be submitted. People are not able to submit the working papers. When the review board calls for the documentation, these documentations are not available for. So this is the biggest challenge. So it says that you have to have the working papers readily available. The conclusions on the basis, suppose if you have derived any conclusion, you have come up for any conclusion, on the what basis? Suppose you have taken the reference of any case laws, etc. To derive any case laws, you put the case laws on the basis of which you have taken the decision. That also has to be mentioned over there, and keep that in the working papers. Deemed dividend, demands, refunds, that are also not reported properly. Now what the tax auditor should do? What is the responsibility of tax auditor? First of all, audit quality. Screen your Form 3CD, workflows before filing or uploading the tax audit report. Start doing this, that is required. Documentation first is mandatory, because tomorrow suppose if your documentation what is required is not there, you will end up in the problem. Adopt Appendix 9C working paper checklist, because the checklist is available. Institute has given you a checklist which is readily available. You have to just fill up that checklist, because everything happens on the last moment, right? You don't have time. Softwares are available. Take the help of the software. Everything is available. Do the work properly. Give the justice. Management letters are there. Follow the ethics. Then formats. Prepare the financial statements as per the formats. Even if it is not applicable, put a habit. Now even the software, if you see tally type of softwares, you can just link the formats with them. AI, you can use these techniques. Now there is no such extra effort is required. Once you inbuild this, it is just a one-time effort which is required. One-time effort, you take the efforts, you can link it. It's one-time job. Everything is readily available. Data AI is available. Link it properly. It is one-time job, one-time effort. Everything is readily available. And transition, because now you are moving to a new era. You have to give more effort, more time. Dedication is required. If you don't do it properly, 3CA, 3CD is just only 2 months job. Form number 26, not TDS return. TDS return form number 26 has gone now. It is 140, 141 now. Form number 26 is new tax audit report for tax year 26-27. That is going to come. Whether you want to do the tax audit in the next year, see that will be helpful or not. Another challenging issue, that is now a person is asking whether in my firm I have 6 partners or 12 partners. A person used to sign 720 tax audit reports. It's told the 12 partners are there, per person 60. So 720 tax audit report of single partner used to sign it. Other partners should not sign the tax audit report. So now the UDN has restricted only in one PAN number, 60 UDN only will be generated. So this was what the case which laws which discussed earlier. So this is the overall limit. Now UDN will not be allowed to be generated. So this is the restriction which is there. So that has been restricted. So per PAN number of the auditor, either you may be a partner of the firm, you may be a proprietor, you may be individual, only 60 will be allowed. So this is the only thing. Revision of tax audit. People are filing the tax audit report, we are revising the tax audit report, but only see that revision of tax audit report should be only in 3 cases. That is, when you are preparing the revision, balance sheet is revised. Suppose if there is a revision on account of changes in the company's balance sheet due to adoption, some changes have come and you need to revise the tax audit report, or if there is some retrospective amendment due to CDBDT circular or some changes due to something, or there is a high interpretation changes or some high court judgment, etc., some type of judgment, then only revise. But you have to give this reference over there and you can revise it, but just don't revise the tax audit reports to mention this, that this is a revised tax audit report. Generating UDs is applicable under subcategories. Now you have to select the subcategories correctly while generating the UDs. One biggest issue is there, whether the revised tax audit UDN will be counted as a 60 UDN or no. I think institutes will allow it. Now what is the changes which has been coming in form number 26? First biggest change is about, now you instead of reporting 44 clauses, you will have to report 55 clauses. Whether you want to charge the fees or not, that is separate issue. That is thing. Another thing is about technology disclosure. That is what is said in the guidance note, says that some fall for 4 or 5 changes is there. You have to mention whether the client is taking the backup daily on a daily basis and whether the data is readily available in India or not. That is one biggest change. So you have to give whether the data was taken up, backup was taken up on daily basis or not, or data is available in India or not. So digital importance has been given, deeper GST and digital data, return level reconciliation of GST R1, 3B, 9 with the books, etc. is given. Then retail schedule wise activation is there, transaction wise TDS, TCS details. These are some of the minor changes in the new form 26. Big changes which has been made, that now that 271B penalty has now become a late fee like 234E. So that has been replaced 271B becomes section 446. So now it will be a late fee, so you have to pay the late fee now. That was a debatable. Now the earlier we would fight it out. So now it is a late fee. Certain documents which are mandatorily required to be maintained, so that suppose if there is a change of auditor, then you have to keep this documentation. This is an illustrative list which is there. Keep on record, NOC, etc. is mandatory. Sign financials, audit reports, though it can be kept in the soft copy, hard copy, etc. But UDIN is a must. These all documents from which link where it can be downloaded, the links have been given to you. Guidance note is available, soft copy is available, soft copy is available free of cost, you can download it. So basically this was related to the guidance note. I think I have tried my level best to cover it in a time. But see that you need to ensure that the trail and the gap of the love of unqualified opinion is permanently maintained. And see that as an auditor you have to be ready always for the inspection. Thank you very much.
Thank you very much.
Any questions if are there?
Yeah, if any questions, members.
Otherwise Yogesh will carry on.
Members, if you have any question for Avinash sir, without which, Acha.
Sir, one query regarding tax audit, maybe not 3CB, 3CD. There is a question that if a partner receive a professional fees, can he go in 44AD or he has to show in tax audit? A partner receiving partnership professional fees from a partnership firm.
Partner is receiving
Professional fees from a partnership firm.
his partner, it will be a remuneration only.
Then
it is his remuneration.
But
How
in
can
that case, if it is the limit is more than the figure,
Rachana Gupta case is there, just refer to it.
okay, and he cannot go in 44AD, right? 44ADA.
Thank you. I would request Viral to please give a formal vote of thanks and introduce our second speaker of the session, Yogesh sir.
Thank you so much, Pratik Bhai, for giving me this opportunity to give a hearty vote of thanks to our first speaker for the day. A heartfelt thank you to Avinash Ravani sir for such an informative and engaging session on the revised ICAI guidance notes on tax audits under the Income Tax Act 1961. So you explained the latest guidelines in a very simple and practical manner, particularly the new reporting formats, UDIN, DPDP Act and other important revisions. Summarizing nearly 608 pages of guidance in just 45 to 50 minutes, and that too so interactively, is truly commendable. With this, on behalf of the members, I would like everyone to please give a heartfelt vote of thanks to our first speaker, CA Avinash Ravani sir. With this, I would like to also introduce the second speaker for the day, CA Yogesh Amal sir. Sir is a commerce graduate from the Mumbai University and a fellow member of the Chartered Accountants ICAI, Institute of Chartered Accountants of India. He qualified in the year 2001 and is in practice since then. Sir has been instrumental in GBCA's foray into business support service and outsourced CFO practice, and his experience in managing audits of large corporates, including listed companies, multinational companies, including PSUs. His area of expertise expands to providing accounting advisory services and is experienced in Indian GAAP, Ind AS, IFRS. He has delivered talks at various seminars for professionals on tax audit, standards on auditing, Schedule 3, CARO, etc. Currently, Sir is a chairman of Accounting and Auditing Committee at Chamber of Tax Consultants and also co-opted member of Accounting Standard Board of ICAI. In addition to contribution to various journals, he has also co-authored for following different publications, which includes BCA's publication on reporting under the new format informed 3CD. He is also been part of WIRC publication and has also been a part of CTC jointly with Taxman in publishing comprehensive guide on Caro 2020. He has also contributed by drafting 4 social audit standards out of the total 16 social audit standards issued, which shall be followed by social auditors while auditing the entities listed on social stock exchange. With this brief introduction, I would like to welcome CA Yogesh Amal sir. And now I would request CA Pratik Maru sir to kindly present memento on behalf of BCSE to our second speaker, CA Yogesh Amal sir. I would request Avinash Ravani sir and Ashwin bhai to kindly present a contribution done by BCSE on his behalf to CABF fund. With this, I would request Yogesh sir to kindly take the charge of this session. Thank you.
Good evening. Avinash bhai for setting up this thing. Good evening, everyone. Thank you, Borivali Central CPA Study Circle team, for inviting and keeping trust in me. Now, this study circle, frankly speaking, has become a family to me. If in a year, if I don't come here, I seriously miss something. So I make sure that I somehow come to this study circle and share whatever best I can share here. Thank you, Avinash bhai, for setting up the context. And pardon me everyone, because there may be some duplication in the talk which Avinash Bhai would have done and I would talk. Because tax audit cannot be spoken without the guidance note. So while I'll make sure that I speak little on what Avinash Bhai has already spoken, but as I said, surely there will be some duplication. And I'll try to give some perspectives or some points which I felt that on those topics which Avinash Bhai discussed, I should add some value or maybe put some additional inputs there. So this will be the background of the topic 1. Let me give the disclaimer which I do always, that I'm a hardcore auditor, not a tax advisor. So there is a possibility that in some clauses, in some cases, there will be typical micro questions on allowability, disallowability, deduction kind of thing. I would refrain myself on those very specific questions. I would look at more from a reporting perspective, that how would, as an auditor, I would look at specific clauses, the reporting and the documentation which I would ensure for my peer review or my regulatory review perspectives. So this would be the large approach. So with this background, let me start the presentation for today. Largely, as I said, without guidance note, tax audit session cannot happen. So these are few important topics which were covered in the revised guidance note, which I would assume everyone knows that and everyone has gone through that briefly, but those are some affirmations which came up from this guidance note, that why the tax audit was introduced originally. Sorry. Then there are some changes as far as MSME classification is concerned during the year. So this is something which we should know as a tax auditor while we are doing tax audit. There are some changes as far as clause 34 is concerned, because section 206 is now no more. So there will be an impact of 194Q. So vis-a-vis 206, 194Q has to be kept in mind. Something very specific, of course, it was part of last guidance note or last year as well, which is clause 36, buyback of shares. So this is one area where one need to be a little more careful, because a lot of transactions are happening around that clause or that transactions area. TAQRB, Avinash Bhai did cover in detail what TAQRB is and what kind of errors they have been observed. Of course, I will also cover a few. I will skip whatever Avinash Bhai have covered, but I would try to cover para by para or clause by clause wherever those are required. Other important aspect which this guidance note touched upon was DPDP Act. Yes, Avinash Bhai did cover well there, but want to add couple of things there. Or rather summarize what DPDP Act largely would be. As we all collect a lot of data in the course of doing audit, we utilize for the specific purpose. So if I have to summarize in couple of words or couple of statements what this DPDP Act is, it is largely about consent management and utilizing the data for the purpose what it is collected. These are two key important areas which one should know in DPDP: purpose and consent. Detail Avinash Bhai did cover, but when I see purpose and consent, now today if you observe on lot of apps on phone, we take only one tick, I read, I agree to terms and conditions. Now post this implementation of DPDP, that will not be the case is what my understanding is. You will have 10 different type of text boxes, because for each of the information which the entities are collecting, they'll have to take consent by each purpose. Therefore, there is a high possibility that you may have 10 different tick box for each of those things. So this is something which is important, which one should keep in mind as far as DPDP Act is concerned, other than what Avinash Bhai already covered. Some more clarifications as far as turnover is concerned in terms of VDAs and carbon credits. How do you treat those as far as your turnover gross receipt is concerned? This is what we would cover. This guidance note is largely limited for financial year 25-26, which is old act. Next year we will see something different. I am sure new guidance also will be coming for that. Guidance note also spoke something more on AI, use of AI. So while guidance note or institute is reckoning that these days we may use some AI tools, but what it clearly says is that irrespective of whatever AI tools we used, the ultimate responsibility will be ours. You cannot rely simply on AI. We will have to do our own due diligence before we conclude any view on whatever results AI has come up. This is something which guidance note has specifically covered this time. UDIN. Again, very specific item Avinash Bhai did cover in detail UDIN as well. But couple of points to add here is the principal change as far as this 60 number is concerned. When we say 60, the limit of 60, that number is limited to financial year, meaning in financial year 26-27 now, I can sign only 60 tax audit, not 60 different client, meaning, or not 60 different assessment years, meaning if for a particular client, for last 10 years no tax audit was done, for all those 10 years, including current assessment year, I do 10 tax audits, my limit get exhausted by 10 and not by 1, because for financial year 26-27 or 25-26, which is assessment year 26-27, it was only 1 year, but there were 9 earlier years as well. So the limit gets exhausted by 10. Very important thing to note and to keep in mind. Certain relaxations in terms of HO and branch offices. They say that if you are doing HO and branch offices simultaneously, then the limit will be counted as 1 and not 2 different limits. If we are performing this as a joint audit activity and assuming a firm is a joint auditor and firm B is another a joint auditor, for both of them 1 unit will be consumed as far as those 60 limit is concerned. So joint audit will be considered as an independent consumed unit for UDIN purpose. So these are couple of more additional inputs on UDIN which Avinash Bhai covered. I'll touch upon one more topic where Avinash Bhai left in terms of revision. He did touch upon where, under what circumstances one can revise the tax audit report. I would want to add one more instance where one can revise tax audit report, specifically in case of clause 40A or 43B. So what happens is, today assuming if I'm finalizing the tax audit report, and under 40A and 43B, there are some provisions which allows me to make those payments until the due date of return filing. So the return filing due date is say 31st October. I finalize today tax audit report, the payments are not made. What will I do as a tax auditor? I will report that those are not made. But practically what happens is, the moment assessee files the return and claims those expenses, my tax audit and the ITR, there will be a mismatch when it comes to processing. So that is rule 6G3, if I am not wrong, which allows or permits to do again a tax audit revision for this limited purpose where one can do. So what will practically happen is, and we have done this practically. So before filing tax audit report, before filing ITR of the client, we will have to revise the audit report only on these two aspects, upload the audit report, and then request client to file the income tax return. Therefore, there will not be any conflict in these two. Otherwise, today, the 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 assessments or lot of things are tech driven. So there is no control. See, there is no way where assessee can convey at the in the course of filing return. See, earlier days, what used to happen when you file the manual return, you used to attach a lot of evidences that you have made the payment, therefore these should be allowed. But there is no such mechanism now. Everything is system based. So therefore, there was a need to come up with this specific rule to ensure that SSC is not at problem. So this is what I wanted to cover as far as revision of tax audit is concerned. TAQRB, yes, we would look at few things. One thing which Avinash bhai touched upon, which is very important observation from not even to a TAQRB, but FRRB. You just pick up any FRRB material. The first thing, or the way we report CARO, as per information and expression given. Now, reviewers are not happy with this kind of disclaimer at the beginning of the statement. It gives a feeling that we as an auditor, we as a chartered accountant have not performed any duty which we ought to, and everything is relied upon the management or whatever information they have circulated. We are simply relying on those information. We are just we have just become a compiler and not the auditor. So not even to a QRB, but even in FRRBs and other reviews which institute takes up on their own for a lot of listed companies, and these observations are from listed companies' annual reports. Big Four kind of auditors also are using this kind of terminology, which neither institute is happy nor these regulators are happy. So wherever we are writing any disclaimers or we are relying on any information which is circulated by the management, make sure that we have performed enough audit procedures as an auditor wherever required, and if beyond that, if something is required and there is no further evidence available, then only you rely on the information which is circulated by the management. So this brings me to a topic called management representation letter. We very loosely use management representation letter as a evidence कि अरे कुछ नहीं मिल रहा है, चलो MRL ले लेंगे client से, हम तो बच गए. हम नहीं बचते हैं. I'm sure we would have read a lot of review orders which are in public domain, may it be of NAFRA or may it be of QRB. First thing first, they pick up these kind of statements. They say, you show me your audit procedures. What are the audit procedures you have performed to ensure whether whatever you have reported right or wrong? Therefore, please be aware that these kind of terminologies are used very sparingly, not in general everywhere. Management representation letter is not a substitute to evidence. It is just an additional piece of paper which will help to corroborate further with whatever evidences you have already collected as a part of audit procedures. Standard of auditing has given enough material to make sure that under a given circumstances, if certain evidence is not available, what are the alternate procedures one should follow or one should do to make sure that you have enough audit evidences. So make sure that we are following all those standards equally while you are doing tax audit as well. Essays are not applicable only to statutory audit. Those are applicable to chartered accountant as a member of ICAI. So those are equally applicable to all the assurance functions which we do, which could be tax audit, which could be transfer price, which could be as simple as certificates which we issue these days. So please be careful on using these kind of specific words. So with this little brief background, let's go to Form 3CD per se. Yes, sir. Yes. All right. So when we discuss that 60 limit, so any audit done for this 44 because of non compliance of this 44 AD or AE, or like if those conditions are not fulfilled and if you do audit, that 60 limit excludes those audit. So largely, if I have to say what kind of audit that 60 limit will be considered is 44 ABA or ABC, which are like any other law for the corporate entities. So these are 2-3 areas which will consume your 60K limit, and these audits will not consume your 60K limit as far as your UDIN is concerned. Presumptive taxes. I am not sure, but my understanding is they are not included. I think there is no change here, if I'm not wrong. But I can look at this specifically and come back to you. So again, see, as such, Form 3CD, there are no or hardly any changes when it comes to last year. So what we are doing is we are refreshing here all those clauses again, like it is more of kind of refresher course. What I would request everyone is to be more interactive here. Maybe that will generate more discussion on the practical side. This is what my request to all of you would be. Otherwise, on technical side, absolute no change as compared to last Form 3CD. So just the objective or the purpose why this Form 3CD was introduced, so that books of accounts, for tax audit was introduced, so that books of accounts are properly maintained by the SSEs. It assists tax officer in assessment, so that they can, so they would collect certain information which would help them in doing the assessment. Since there is a watch as far as audit is concerned, SSEs would tend to prevent or not do some fraudulent activities, because auditor is not going to spare them and they are going to repeat this, they are going to report these. So these were few important objectives why this tax audit per se was introduced. However, the primary responsibility of preparing tax audit reports, or rather I would say Form 3CD, always rests with the SSE. We as an auditor are only supposed to review and comment on them. We should not involve or engage ourselves in preparing those activities, those reports or those annexures, which again is very much clarified in guidance note. I mean, there is some confusion. If you see the basic form of form which is released by the department, you don't see SSE's signature, you see only chartered accountant signature on the last page. But guidance note is very clear on that. It has to be both SSE and auditor. So, and of course we also follow the same practice, that we obtain the SSE signature first and then we sign. Basic conditions, I think nothing much here in terms of turnover criteria. What would be covered, what is the turnover limit, 1 crore, 10 crore, digital transactions, only 5% of cash, so on and so forth. Nothing new again here. Professional 50, 75. Yes, yes, yes. Because of course we take hard copy and we also upload the hard copy along with, yeah, very much, very much. So we upload. So none of our tax audit uploads will be without that attachment of Form 3CD, which is signed both by auditors. Because what happens is, in the online scenario, you don't have enough spaces to report. So what we do is lot of disclaimers, a lot of reliance, or a lot of views where we may differ from SSE. We report in that physical copy. In our 3CA or 3CB, whatever it clearly mentions that the physical copy will prevail over the uploaded copy, because there are limitations there. I cannot convey everything which I want to convey, which we clearly cover in Form 3CA or 3CB wherever required. So yes, it is necessary we take this. Sorry? It is mandatory. It is mandatory. See, I think it is, yes. In one of the, so no, it is in other attachments. It is in other attachments. It is not mandatory, but we do. We do. It is not mandatory. It is only asking as a mandatory field of financials when we upload the tax audit report. It asks for balance sheet, it asks for P&L, it doesn't ask for a tax audit report, but we do as a part of other attachments. See, the reason is, as I said, you may want to convey a lot of views. You may not agree to a lot of views or positions which the SSE would have taken. How would you save your skin? Either you upload, or maybe on later date you send a physical copy to the respective AO that this is our copy. It is better to upload where the option is available. And as I said, we do cover this in 3CB, 3CA wherever required. That physical copy should prevail because we have put in a lot of our comments or our feedback on the physical copies. So if you see typical tax audit report from my office, there will be at least 4 pages of additional comments as a part of my 3CB on various paras which we would include there. So in addition to 3CB, 3CD, there will be this around 4 pages ka, I would not say qualifications, but some communications or some information in addition to 3CB and 3CD, and which again we also upload. I think this was about turnover. Simple, what includes turnover, what does not include turnover. I think from ages we are following this. Would want to highlight only one new topic or one new area which has included this year specifically is sales proceeds of VDA, virtual digital assets, and carbon credits. So if the SSE is into the business of VDAs or carbon credits, then even the gross receipts from sale of those assets will be part of your turnover. So this should be including included in the turnover or a gross receipts when you are calculating the applicability or limit of threshold for tax audit purpose. So this was one additional area which has come up in new guidance note. I'm sure in detail Avinash ji would have covered, but just keep this in mind. There are some additional literature material which have come up from department in terms of VDAs, virtual digital assets, how would those get taxed and all those things. But if one is into the business of dealing into this, it will be considered as a part of turnover. For first time, they've come up in this new guidance note some more specific exemptions. Of course, it was always understood that way, but they have come up specifically 3-4 additional items which they say that these would be not forming part of turnover. One such amount is any amount written back which was payable to creditors, or any provision for expenses which are reversed. Now, all those things will not be considered as a part of turnover for the purpose of determining whether the tax audit is applicable or no. Any bad debts recovery will not be considered as a part of turnover or a gross receipts. Any section 1 liability which is remitted, those will not be considered as a part of turnover, and any capital receipts will again not be considered for the purpose of considering turnover as far as tax audit limit is concerned. We are not discussing taxability. We are only discussing what should be considered, not considered for the purpose of calculating turnover for the purpose of tax audit. While there is nothing new this year for GST, but I would still like to highlight GST, if it is part of P&L, meaning if one is following inclusive method, of course we will discuss inclusive exclusive method little later, but if one is SSE is following inclusive method wherein sales is recorded as 118 in P&L and not 100, say for example, then even this 18 is to be considered as a part of turnover. However, if exclusive method is followed, meaning sales is recorded as 100 and 18 is recorded as GST payable, output liability, so on and so forth in balance sheet, then it does not, then it is not considered as a part of turnover for the purpose of determining whether tax audit is applicable or not. we did discuss this new additions and exclusions. So tax audit report. So as a part of tax audit report, there are two important piece of document, which is one actual report in the form of 3CA or 3CB and 3CD. 3CD is largely a factual question answer statement, largely barring couple of clauses where they are asking for allowability or disallowability, but otherwise it is largely a factual question answer statement wherein one has to simply answer to the questions which they are asked, meaning one has to only report the information which is requested for those clauses. This is, as we discussed earlier, that this is the primary responsibility of SSC, and we as an auditor will have to review the particulars which are reported in Form 3CD. On top of that, we will issue Form 3CA or 3CB, whatever applicable, on Form 3CD. Now Form 3CA and 3CB are our audit report. I'm sure all of us are following the format which is largely aligned with SS 700, because if you download Form 3CA or 3CB from the department's website, it does not cover the management responsibility, auditor's responsibility statements. Institute says those have to be included. So I'm sure everyone is aligned on those reports. So meaning in 3CA or 3CB, like we have a normal statutory audit report where there are management responsibilities and auditor's responsibility, we have those paragraphs in those forms as well. 3CB typically is for entities where there is no other audit applicable under any other law. 3CA is typically applicable for entities where audits are applicable under any other law as well. Meaning for corporate entity, we generally issue 3CA, and for non-corporate entity, largely we issue 3CB. Does that mean that for corporate entity there cannot be 3CB any time? The answer is no. There is a possibility that even for corporate entities there can be 3CB under circumstances. One classic circumstance which I can highlight is for the closure of book, say the SSC is following Jan to December, where your auditor's report, the statutory audit report, will be for Jan to December and not for April to March. Therefore, you as a tax auditor will have to issue Form 3CB, because you have to opine true and fairness for April to March and not Jan to December. Therefore, under such situations, you will have 3CB. Merger, demerger, those kind of situations also may warrant Form 3CB for corporate entities. One has to be careful when you are what kind of reports is applicable and what are we issuing. In Form 3CD, as we discussed, that it is largely the responsibility of management we are reviewing. So what happens under certain paras or under certain clauses where we are not agreeing to what management has reported, or we have relied on certain judicial pronouncement or something else or some other literature. We tend to report under all such clauses these kind of additional information. For example, if depreciation by act is say 100, but by say virtue of some case, I'm just giving an example, but say by virtue of some case law you have a bright chance to claim it 120 and the SSC has done that, we would tend to report that reliance has been placed on XYZ case law where this has been done in addition to what normally it ought to be. There could be some clauses where you may not agree with SSC. So what we do is the reporting under those clauses would be SSC's response, and then we have auditor's response. We have two separate para to those clauses. Again, example, clause this chapter 6A deductions or brought forward losses deductions, or largely on clause 31 reportings, where you may not have certain information, account pay checks. The SSC has not kept the evidences of account pay check, which doesn't happen frankly today. But SSE would say that I have all the transactions as account pay check. So we will have an additional statement under auditor's responsibility that we have relied on this, or we've so and so forth. So there is a high possibility that in many such clauses we may have an additional clarification as a part of auditor's response as far as Form 3CD is concerned. And that's where I mentioned that it is important that we take a signature on physical copies and also share those with authorities, because tomorrow it is not only relevant to income tax authority, but all these reviewers, say QA, TAQRB, or your peer reviewer, or your QRB or NAFRA. I mean, everywhere if you have taken certain positions, you have to highlight as an auditor on what basis have you taken those positions. Therefore, it is important to maintain those necessary documentation on what basis you have taken those positions. Whether very important aspect of our auditing in terms of very important assumptions of materiality, prudence or substance over, do we consider all this as a part of tax audit also? Yes, the answer is yes, we do consider all these things, and we would follow the same methodology or same process which we would do for a normal statutory audit. So SSE, assuming is a individual and it has got a multiple concerns. So Form 3CD, the question is whether it is qua SSE or qua concern. Qua SSE. I think it's simple, it is qua SSE. So typically there should be only one Form 3CD for SSE's multiple businesses. Maybe while reporting you may do the segregation, and again here the importance of physical copy comes, because if you are auditing two concerns, for uploading part you have no possibility to reflect those separately, assuming you've taken a loan of say 100 rupees from under both the concerns from person A. Now there in uploading you will merge all those amounts, but in physical copy you can maintain the separation that out of 100, 80 was in concern A, 20 was in concern B, so on and so forth. So again the relevance by physical copy becomes more important. I think this is little brief before we jump onto clauses. Pratik bhai, do we want to take a break or like?
Members will take a break for 15 minutes and then again resume this session. It is on second floor, so all are requested to come on second floor only.